fast, where truth moves faster than a Holstein calf. No waiting on some pretty page. We're charting new ground in the digital age. From genomic codes to row-wide facts, we cut through the noise, no holding back. Not your daddy's dairy news tonight. We're sparking debates with every insight. The ring's not where the real fight's at. It's in the data, in the channel chat. From pasture to processor to your morning cup, we're raising the stakes. Try and get ahead of herd. Yeah! Where the future's more than just a word. Ahead of herd. Come on! The bullvine's calling, let your voice be heard.
Welcome back to the Bullvine Podcast, where we cut through dairy industry noise to get you the insights that actually matter for your operation.
And today, we're diving deep into a feature piece about genetic alignment.
This should honestly be mandatory reading for every producer. We're talking about the surprising gap between what the proof sheets promise and what your milk check delivers.
Right. It's a gut check on profitability. And it's not about finding the highest ranked bull in the catalog. It's about something much more fundamental.
It is the core paradox of modern dairy genetics. We're looking at hard data that shows the exact same genetic potential bull semen from the same tank.
The same tank
can lead to a catastrophic $190,000 annual loss on one farm.
Wait, hold on. $190,000
annually.
Yeah.
While at the same time, it's generating a $57,000 margin gain on a farm of similar size, maybe just down the road.
A six-figure swing based on genetics that are supposedly identical. That sounds almost impossible. We're all chasing the same indexes, aren't we?
That's the myth we're busting today. The difference isn't the genetic quality. It's pure, simple alignment. The analysis we reviewed proves it pretty conclusively.
Fit beats rank.
Fit beats rank every single time.
Okay, I'm listening. Because on the farm, we see it. The pace of genetic progress is accelerating for sure. The indexes are climbing, genomic selection is doing its job.
Right.
And yet, I agree, that gap between the top 10% of profitable farms and, the average guy seems to be getting wider. Why is that?
Because, as the analysis puts it, we are paying for genetic potential that our specific farm system, our market contract, or our management practices simply cannot capture.
So we're optimizing for a ghost market.
Exactly. And that's where this quiet profitability drain starts. Let's set the stage, because the context here is critical. This conversation about alignment couldn't be more timely, really.
Things are always shifting.
They are. And we just saw a major industry driver that forces this reevaluation. The USDA's April 2025 NM1 net merit dollar revision.
That revision is key. It completely changes the goalposts. It fundamentally shifts the weighting, putting a much heavier emphasis on components and efficiency.
It's essentially telling the industry that chasing pure volume is, it's an outdated strategy.
And the stakes here are huge. We're not talking about small adjustments, are we?
No, not at all. We're discussing what the sources call a quiet profitability drain. You invest $50 in high merit semen, you spend 2 years raising that heifer.
All that time, all that feed.
And then you realize you optimized her for the wrong thing. That six-figure annual loss on a moderate-sized 600 cow herd, or that potential $57,000 gain.
That is the difference between reinvesting in infrastructure and just fighting to hold on to the status quo. It's the difference between grinding and progressing.
Absolutely. The psychological pressure of that quiet drain must be immense because the bulk tank looks full.
Right. The tank is full. You think you're doing great, but the efficiency metrics are just slowly eating you alive from the inside out.
Which brings us directly to the inherent controversy this deep dive explores. For decades, the dairy industry's focus, heavily influenced by AI stud marketing, has been on one question.
Which bull is best?
Which bull is best, exactly. The analysis we reviewed challenges that premise entirely. The conversation has to shift to which bull fits my system.
It sounds like common sense when you say it out loud. But we often ignore common sense when there's a huge NM1 number flashing at us on a monitor.
We get seduced by the rank.
Totally.
And the sources also tease a massive long-term risk tied to this. It's about genetic concentration. We have to discuss why the most successful sires in recent memory, names like Mogul, Oman, Planet,
legends,
they now actually pose the biggest systemic risk to the breed's overall diversity and long-term health. That's a real quantifiable cost, and we need to unpack how it hides in your conception rates and your feet and leg issues.
That's terrifying. The success of a bull is measured by units sold, and that very success is exactly what leads to the long-term risk of inbreeding depression.
It's a vicious cycle.
It is, and we need to address it with practical strategies, not just, academic warnings that we all file away somewhere.
Okay, let's unpack this using the structural framework from the source material. The 3 interlocking gears. This is the foundational model for achieving alignment.
I love this image. A machine only works smoothly when the gears mesh. If they don't, you get that expensive, grinding friction.
Gear 1 is genetics. That's your breeding program.
Yeah.
What specific traits, volume, fat, protein, health, stature, calving ease are you actively selecting for?
Gear 2 is the market. Your contract with your processor. What are they actually paying you for? Is it a fluid milk contract where volume is king?
Or is it a class 3 or class 4 plant cheese, butter, powder, where high components translate directly into premium checks?
And then gear 3 is management. This is your physical system. Do you run a robotic milking system? Are you short on labor and need maximum longevity? Are your feed costs through the roof?
Do you have high replacement costs? This gear defines the environmental constraints and the actual costs of your operation.
And if those 3 gears, genetics, market, and management, don't mesh perfectly, you don't get smooth progress. You get grinding.
And the sources give a fantastic, terrifying example of a herd where these gears were actively grinding, leading to massive financial loss.
Let's do it.
Let's dive deep into that specific case study, the $190,000 drain. So picture this, a 600-cow Midwest freestall operation.
Okay.
The critical detail is their market. They ship class 3 milk, primarily going to a cheese plant.
So a high-component premium market. The market gear is literally screaming, we want solids, we need protein to maximize cheese yield.
Exactly. Based on that November 2025 component price data we reviewed, protein was priced at over $3 per pound.
$3. And butterfat was high too, at $1.71 a pound. That's where all the value is concentrated.
But the genetics gear on this farm was spinning in the complete opposite direction. They had this legacy breeding program focused entirely on volume.
Big, powerful production sires, just chasing high milk numbers year after year.
The manager saw a full bulk tank and assumed everything was fine.
But the component test must have told a different story.
A brutal story. Their cows were optimized for volume, producing massive amounts of water and lactose alongside the solids. They were running a test of only 3.6% fat.
Which is low?
And a painful 2.95% protein.
Oh, wow. 2.95. Let's just pause on that number. That is a huge red flag.
It's massive. The Canadian Dairy Information Center's 2024 data suggests that the average modern Holstein herd should be hitting around 4.15% fat and 3.36% protein.
So this operation is dramatically behind the breed average on the one component that their processor rewards the most.
They are essentially trying to make cheese with skim milk.
They are optimized for a fluid milk check that disappeared 10 years ago when they signed that Class 3 contract. It's the perfect misalignment.
And the sources meticulously quantified where the money leaks out. First, protein. Running 2.95% protein instead of the 3.2% or 3.3% that other successful herds were achieving meant they were leaving roughly 75 to 90 cents per hundredweight on the table.
Just on the protein premium alone.
Just on protein.
When you factor that volume over a whole lactation, what does that translate to?
It's a staggering $140 to $195 per cow per lactation in foregone protein revenue.
That's money they earned but didn't collect because the genetic instructions were just wrong.
Then you add the butterfat gap. That 0.3 to 0.4% difference in fat test adds another $95 to $125 per cow per year in missed premiums.
And this is where the third gear management starts to fail them as well, right?
Right, because they are selecting for high volume, low component cows. They are forcing the system, their feed, their metabolism, their labor, to move more water through the cow to get the necessary amount of solids.
It creates a tremendous feed efficiency drag. They are literally investing feed dollars to move water, not to generate the higher component revenue the cheese plant is paying for.
The cows are highly productive, but terribly inefficient for that specific contract.
You stack all those losses up. The protein premium loss, the butterfat gap, and the drag from inefficient feed use.
The estimated annual cost for this 600 cow herd is approximately $150,000 to $190,000. It's devastating.
Almost $200,000 in revenue the processor was ready to pay. And the producer feels good because the tank is full.
That's the nature of the quiet train. It's invisible until you analyze the component revenue share.
Which brings up a critical definition we need to establish right now. We keep using the term component revenue share. For the producer driving the tractor, what is that, simply?
It's just a percentage of your total monthly milk check that comes from component premiums, butterfat, and protein pounds, as distinct from the baseline fluid volume pay.
So if you're selling into a high component market like this Class 3 plant, your component revenue share should be what?
Well over 25%, maybe even pushing 30% depending on the month. If you are chasing high NM bulls and your component revenue share is only 15%.
You have just exposed your six-figure drain.
That's it.
I'm not willing to call the cows bad, though. They were bred to produce high volume, and they succeeded. The issue is they were optimized for a fluid milk system that this specific operation no longer runs.
We have to stop looking at the proof sheet in isolation and start looking at the market contract as the primary genetic filter.
That lesson, optimization for volume in a component market, is a recipe for expensive grinding, leads us directly to the indexes.
It does. Because if our market check is telling us one thing, but our breeding program is following NM to the letter, we need to understand what that index is actually prioritizing.
That's our next deep dive segment, Industry Reality Check, understanding what you are actually buying when you choose an NM Muller or TPI bull.
These indexes, NMBU and TPI, they're necessary starting filters. We use them. But, as the analysis points out, we have to treat them as tools with known biases, not as some religious text that guarantees profit.
And that April 2025 NM revision is the critical context here.
Okay, let's unpack the USDA's philosophy behind NM $2025. It is explicitly designed by the USDA's Animal Genomics and Improvement Lab to maximize lifetime profit.
For an average U.S. Holstein herd.
Selling into average market conditions.
And that word average is the danger zone for specialized farms, isn't it?
It is. The weighting tells the story of what the USDA sees as the future of profitability.
Right. So the 2025 revision places a massive 31.8% emphasis on butterfat.
31.8. And 13% on protein. And then a combined 17.8% on feed saved.
Which is your body weight composite and residual feed intake, or RFI.
Exactly. That is a heavy structural lean toward components and metabolic efficiency.
So what does that weighting tell you from a practical perspective?
It tells me that the USDA recognizes that pure volume chasing is a mug's game. The future is concentrated product and efficient use of inputs.
They're telling us that feed costs and components are the two biggest levers for the average operation.
But let's compare that to the competition. TPI, Total Performance Index, is often the preferred index for operations that focus on selling breeding stock or show cattle.
Yeah, and why is that? Because TPI places a higher value on conformation, aesthetics, structural integrity. They need that cow to look good, last well, and be marketable to other breeders.
It's not just about milking efficiently for cheese.
Exactly. My neighbor who is selling embryos and breeding stock should probably use TPI because his market rewards appearance and deep pedigrees. I, however, am selling ingredients to a food company.
So if you follow TPI, you might be paying for traits like mammary system depth that don't increase your component revenue one bit.
Not one bit.
And here's the key distinction for you listening. If I'm a producer in a fluid market in the Northeast with minimal component pay, and I follow NM by religiously, that 31.8% emphasis on butterfat could be steering me into paying a premium for a trait my market barely rewards.
You're paying for semen that maximizes butterfat yield, but you're getting paid mostly on volume. A total mismatch.
And conversely, if I'm that Midwest cheese plant operation from our first example, NM1 is helpful, but it might still underweight the protein component that drives my biggest revenue stream.
It's a superb filter, but it doesn't replace the requirement to check the 3 gears.
This highlights that modern genetics are specialized tools, not universal solutions. We have to look at specific elite sires to understand the inherent costly trade-offs built into their genetics.
The analysis gave 3 great contrasting examples. Let's start with De Novo 2776 leads. He's massive in the industry.
Huge. His value proposition is focused on reducing labor and calving interventions. Great calving ease. He traces back to the DSU-frazzled 6984 family, known for commercial functionality and easy births.
You buy leads to reduce pulled calves and those nighttime labor calls.
But what is the trade-off? The sources note that leads has essentially flat components. And the physical reality of breeding for extreme calving ease often means compromising structural integrity.
Smaller, finer skeletal structure, narrower pelvis, things like that.
So if my assisted births are already under 15% because I have good labor and management, am I really benefiting from paying a premium for leads while sacrificing structure?
Which might just lead to higher involuntary culling later on.
Exactly.
Probably not. The sources make a compelling case that the structural compromise or lower component test might cost me more in the long run than the $100 I save by not calling the vet to pull a calf.
You have to analyze your specific management deficiencies, not just the index average.
Okay, next up, De Novo 6856 Hotshot. He's explicitly focused on health, livability, and longevity, coming from that BOMAS perfect P line.
Longevity is gold on paper. We all want a cow that lasts through 5 or 6 lactations, especially when replacement heifers are costing a fortune, which we know they are right now.
But Hotshot is a moderate milk-proof bull, so the trade-off is clear. If he's giving me 6 or 8 pounds less milk per day than an alternative, do I actually win?
Only if the cost savings from his longevity outweigh the lost revenue from lower production.
And if my replacement costs are already low, or if my feed costs are through the roof, that lower production proof might negate all his longevity benefits.
You have to run the 5-year math, the full economic analysis on those lower producing daughters to see if the specialization actually pays off in your specific system.
And finally, a bull like Urzakari from Synetics. This is a hyper-specialized tool.
He's explicitly optimized for robotic milking systems traits, like specific teat position, ideal udder balance, and superior locomotion for navigating the barn quickly.
That is the epitome of the alignment principle. If I run a $1.5 million robotic parlor, I absolutely need these specific traits.
If Urzakari shaves 30 seconds off every milking visit for 100 cows, that's huge.
Massive labor savings.
But if I run a conventional double-8 parlor, I'm paying a premium for specific teat length or positioning that is utterly irrelevant to me.
And you might be compromising on a component trait you desperately need just to get a robotic-specific feature.
The takeaway here, for everyone listening, is that none of these elite sire's leads, Hotshot, Urzakari, are universally optimal. They are specialized tools.
And you must ensure the philosophy you are buying matches your economic reality.
Now that we understand the cost of misalignment and the bias of the indexes, let's follow the money trail.
This is where we see the immense economic potential of proper alignment, the quantified, repeatable $57,000 advantage.
We have to start with component prices. They're volatile, but their long-term trend is undeniable. Solids pay.
We saw that November 2025 AMS data, protein over $3 a pound, fat at $1.71. That relationship flips sometimes. Butterfat was over $3 a year prior, but you have to breed for the long term.
Absolutely. The long-term global signal is clear. Demand for solids, butter, powder, cheese is structural. But the other massive lever,
the one that is always there regardless of price volatility,
is feed efficiency.
This is the biggest factor the NM 2025 revision targeted. Feed costs average a devastating 58% of milk income, according to USDA data.
58%. 39 for production, 19 just for maintenance. If you can move that needle, you win the game.
And the NM revision acknowledged this by placing 17.8% emphasis on feed saved based on body weight composite and residual feed intake, or RFI.
We can't just gloss over RFI. We need to explain what it is and why it matters so much.
Okay, RFI is the metabolic efficiency of the cow. Think of it this way. You have 2 identical pickup trucks hauling the exact same load, say 5,000 pounds.
Same distance, same load.
But one trick is finely tuned and burns 10% less fuel to do the job. That saved fuel is RFI.
In a cow, RFI is the difference between her expected feed intake, based on her size and production, and her actual feed intake. Selecting for negative RFI means you're selecting for a more efficient metabolism.
A cow that gets the same job done, but uses fewer resources. The sources confirmed it has moderate heritability, about 0.15 to 0.25, meaning we can definitely make progress on it.
Now let's get into the detailed, powerful calculation that proves fit beats rank. Comparing cow A, who is volume focused, and cow B, who is component aligned.
And this is in a 500 cow class 3 market, using those specific November component prices.
Cow A is the volume cow. She gives 62 pounds a day with lower components, 3.7% fat, 3.0% protein.
Cow B is the component cow. She gives slightly less milk, 56 pounds a day, but is highly concentrated. 4.2% fat, 3.3% protein.
On the face of it, the volume cow looks like the winner, right?
Yeah.
More milk in the tank.
But when we run the revenue calculation based on that Class 3 contract, cow A generates about $2,904 per lactation.
And cow B.
Cow B generates $2,927 per lactation.
So the component advantage for cow B is only $23 per lactation. That's not what's going to convince a farmer to switch.
No. The real magic happens on the cost side, where efficiency meets alignment.
Precisely. Cow B produces less overall volume and higher concentration, which means she requires less dry matter intake over the lactation.
The calculation showed cow B requires 375 pounds less DMI over 305 days to achieve that slightly higher revenue.
Now we apply the cost. At the value used in the NM 2025 feather calculation, 13 cents per pound of DMI, that 375-pound saving
translates to a $49 per lactation advantage for the component-aligned cow, cow B.
That's double the revenue advantage just in feed savings.
And here's where the NM War vision really rewards us. We add in the RFI advantage. If cow B has just 3% better residual feed intake, which is a conservative, achievable goal,
Right.
that's an additional 325 pounds of DMI saved. That nets another $42 per lactation.
Wow. So the total advantage for the component-aligned cow B is $23 from revenue, plus $49 from baseline feed savings, plus $42 from RFI.
It totals approximately $114 per lactation.
That is the core number. $114 per cow, achieved not by getting the highest price or having the most volume,
But by buying the bull that aligns with their Class 3 contract and focuses heavily on efficiency, scale that up to a 500 cow herd, and you've unlocked a $57,000 annual margin gain.
And that money goes straight to the bottom line because it's a structural efficiency improvement.
And the analysis stresses the flip side, which brings us back to alignment. In a fluid market with minimal component pay, the math completely reverses.
Cow A's extra volume generates significantly more revenue, and the feed efficiency advantage shrinks dramatically because you aren't capturing the component value.
It underscores that you must calculate the return on investment for your specific contract. Efficiency is always a premium, but that $57,000 only materializes if the market is ready to pay for the concentration.
The gears must mesh.
They have to.
That discussion on efficiency and component value proves that these market signals are not temporary blips. They are structural changes. Let's look forward to future implications.
Because the global component shift is only accelerating.
If we connect this to the bigger picture, we see that North America is following a global trend. Look at European and oceanic systems. We reviewed data from Ireland,
Right.
where January 2025 milk fat content averaged 4.51% and protein hit 3.58%.
That's a fundamentally different cow than the U.S. average.
And New Zealand's Fonterra, a massive global exporter, bases its milk price on standardized benchmarks of 4.2% fat and 3.4% protein.
That's a direct reflection of decades of component breeding required in their pasture-based system.
Even more telling. Across the EU, the demand for fat pushed butter prices to record highs in early 2025, hitting over 7,000 euros per metric ton.
Which was a 36.5% increase over the previous year. Analysts are calling this fat premium structural, not some temporary blip.
This means every processor globally is going to demand more solids and concentrated product.
And that means one thing for our listeners. Processor contracts are tightening everywhere. If your herd is currently misaligned, the next contract renewal could be financially painful.
We're seeing major regional shifts already, like the massive component pricing change coming to Western Canadian provinces.
That change, effective April 1st, 2026, is a fundamental rebalancing of value, moving the ratio from 85% fat and 10% protein to 70% fat and 25% protein.
Wait, hold on. 85, 10 to 70, 25.
Yeah.
That's not a nudge. That's a seismic shift toward protein value.
If you're a Canadian producer who has been selecting for butterfat over protein for years, you have precisely 1 year to fix that genetic trajectory before the financial penalty hits hard.
And the U.S. is following suit.
Yeah.
New processing capacity, especially new cheese and drying plants, comes with stricter, non-negotiable contract requirements.
The analysis suggests that today's direct contracts increasingly expect protein tests to be consistently above 3.2%.
So if your genetics have drifted toward that 2.95% mark, as in our misalignment example, You're going to be scrambling to keep your component revenue share up.
Genetic decisions made today must explicitly anticipate tomorrow's stricter contract standards 2 to 3 years down the road.
And this structural tightening of the market directly impacts another major trend we see on the farm, the beef-on-dairy connection.
Oh, yeah. Let's look at the data because it's staggering. 7.9 million units of beef semen were sold to U.S. dairy operations in 2024.
That represents over 80% of all beef semen sales in the entire country.
For the bottom tier of the herd, this is an aligned, profitable management decision. If a cow isn't productive enough or healthy enough to produce a high-value dairy replacement, you breed her to beef.
You optimize your calf value, and you reduce replacement raising costs. Beef-on-dairy crossbreds are an indispensable part of the fed slaughter market now.
But the critical structural issue here is the corresponding drop in dairy heifer inventory. The sources note that dairy heifer inventories are at 20-year lows.
2.5 million head as of January 2025. Co-bank projects, we will have 357,000 fewer dairy heifers entering the herd in 2025.
This creates a compounding risk. If you are using beef on over 40% of your herd, which is the threshold cited in the analysis as a management red flag,
you have made your genetic pool smaller.
You must be absolutely certain that the replacements you are keeping come from only your top component-aligned genetics.
Accidentally breeding beef on a high-merit, component-focused cow, the one you should be using to produce your next high-performing replacement, is a devastatingly costly mistake.
Especially given this current heifer shortage. That's the misalignment trap again. Using beef is smart, but using it on the wrong cow is a long-term profit killer.
Due diligence is everything when your replacement numbers are this tight. You can't afford to make an expensive mistake that takes 2 years to discover.
That structural pressure tightening markets and low heifer inventory pushes us directly into our contrarian take.
The cost of genetic concentration. We have to challenge the popular narrative that faster genetic gains mean everything is fine.
Genomic selection has been a miracle for increasing profitability traits, absolutely. But the analysis warns that it also sped up the concentration of the breed.
We are focusing on fewer and fewer powerful family lines because they have proven high NML.
The source's site estimates that the effective population size of Holsteins, which is a technical measure of genetic diversity, is only 66 to 79 animals.
Wait, only 66 to 79 animals? Considering there are millions of Holsteins milking worldwide, that sounds incredibly low.
It is, and the critical threshold for long-term adaptability concern is generally considered to be below 50. We are dangerously close.
So why is that number so important? Why does low effective population size matter to the producer today?
Because it's the breed's insurance policy. If diversity drops too low, the entire population becomes highly vulnerable to a new disease or a sudden, drastic environmental change.
Say, an unexpected heat wave or a sudden shift in available forage quality.
If every cow traces back to the same few ancestors, the whole herd is susceptible. It's a huge risk.
That's terrifying. Dr. Chad Dekshow at Penn State has documented how rapidly genomic selection concentrates these genetics. The problem is insidious because when you request an outcross bull,
You think you're getting something different?
once you unfold his pedigree far enough, he often traces back to the exact same influential sires. Mogul, O-Man, Planet, or Super Sire.
This is the Mogul paradox. Mountfield SSI DC Mogul exceeded 1 million units sold by age 7, a record. He was a phenomenal bull, and his daughters delivered production.
But the sheer scale of his success means his genetics are now the foundation of the entire breed structure.
And that level of market penetration means that when I buy a highly ranked bull today, I may just be deepening my inbreeding coefficient and increasing my connection to Mogul.
Rather than diversifying your gene pool. Checking kinship data isn't being paranoid anymore. It is now absolutely essential due diligence.
And the economic bite of this concentration isn't theoretical. It's being quantified right now.
This is where it gets really interesting. The sources cite Italian research showing the hard cost. A 1% increase in genomic inbreeding is associated with about 134 pounds, 61 kilograms less milk.
134 pounds less milk per lactation for every 1% increase in inbreeding.
And the losses are compounding year after year, hiding behind the overall positive genetic progress of the herd.
German research confirms this trend. They're showing 32 to 41 kilograms less milk, 1.4 to 1.7 kilograms less fat,
and 1.1 to 1.3 kilograms less protein per 1% increase, plus and this is the killer for management, calving intervals stretched by a quarter day.
A quarter day seems small, but if you stack that up over a 600 cow herd year after year, that reduced fertility and stretched interval is a huge loss of efficiency.
It's the definition of the quiet profitability drain we discussed earlier.
The Wisconsin producer the source is quoted nailed this disconnect perfectly. He said, "The daughters are producing more milk than their dams, so the genetic progress is real."
But conception rates and feet and leg issues have gotten harder to manage. I'm not sure the net gain is as large as the proof sheets suggest.
That quote perfectly encapsulates the cost of concentration. You are gaining on the production front, but you are losing ground on the health and fertility front, the management side.
Due to concentrated genetics and inbreeding depression.
So finding genuine diversity requires effort. You have to look outside the top 100 bulls. The analysis suggests actively looking at niche Holstein lines, legacy maternal lines like Hanover Hill, Meteor, or Durham.
For 5 to 10% of your matings. This maintains your options for the future.
And crucially, this is where technology becomes affordable. For $40 to $50 per head, genomic testing your top-tier heifers isn't an optional expense anymore.
It's a necessary investment to accurately track inbreeding, kinship, and ensure you are keeping the highest merit replacements. You can literally see which ones are too closely related to your sire battery.
You remove the guesswork. You have to actively select and utilize one genuine outcross sire from an underrepresented maternal line, even if his NM mole isn't top 5.
That 5 to 10% investment in diversity is an insurance policy against future disaster.
Okay, we've covered the problem, the cost of misalignment, the economic advantage, the market shifts, and the risk of concentration. Let's wrap this up with our actionable review.
Focusing on a recovery story and a red flag checklist.
The recovery story from the 550 cow Minnesota operation really brings this alignment concept home. It gives us hope.
They were chasing high TPI for 8 years, using genetically sound bulls, but their protein test slid from a respectable 3.25% down to a painful 3.05%.
They realized they were leaving over $180 per cow annually in component revenue on the table because their genetics gear was simply wrong for their Class 3 market gear.
They made a difficult pivot, changing their selection criteria.
They filtered hard for positive protein deviation and strong component balance, regardless of the overall TPI ranking. They were willing to sacrifice 50 or 100 TPI points to achieve better alignment.
And 3 years later, their protein test is back up to 3.22%. And the manager's takeaway is exactly the lesson of this deep dive.
He said, "The genetic progress feels slower on paper. Our index rank isn't as high, but the mill check is bigger. That's the number that actually matters."
That is the ultimate proof that fit beats rank. Measure the margin, not the index points.
All right, let's turn this entire discussion into an immediate, actionable checklist for you. These are the 5 red flags that signal your 3 gears may be grinding right now.
Red flag number 1. Your fat or protein test has dropped 0.2% or more over 3 years, while you are selecting high NMMO bulls that emphasize components.
If you are paying a premium for component genetics and your components are decreasing, something is fundamentally wrong. You are losing component revenue you paid for.
Red flag number 2. Your component revenue share, that percentage of your total check from components, is under 20%, but you are heavily using component-focused sires.
This means your market doesn't reward the genetics you are buying. You might be better off pivoting toward volume or balanced sires and stop paying that premium.
Red flag number 3. You cannot find a prospective sire with less than 8% relationship to your core herd ancestors.
That is the flashing warning sign that genetic concentration has narrowed your options too much. You need to actively look for outcrosses before inbreeding costs hit your conception rates and health.
Red flag number 4. Your processor has recently mentioned tightening component thresholds or premium structures.
Look at the Western Canada shift. Look at the U.S. requiring 3.2% protein. If you hear these signals, your genetic decisions today must anticipate those stricter standards 2 years from now.
And finally, red flag number 5. You're using beef genetics on over 40% of your herd, but haven't genomic tested your dairy replacements.
This is a massive risk in a tight heifer market. You are shrinking your genetic pool, so you must know precisely which cows hold the highest genetic merit for your future herd.
Genomic testing removes the guesswork entirely.
If you check 2 or more of those flags, you need a formal review of your breeding program's alignment immediately.
All right, a farmer just finished milking and is driving to the feed store. What are the 3 core practical actions they need to remember from today, broken down into timelines?
We've got 3 core actions for you: market, genetics, and efficiency.
First takeaway, know your market's reward. Remember, Fit beats rank.
Immediate action this week. Pull your last 6 milk checks and calculate your component revenue share. It's a 5-minute exercise. If you are selling into a component market, aim for over 25%. If you're under 15, you're paying too much for genetics your market ignores.
Medium-term strategy, 3 to 6 months. If misalignment is confirmed, review the weighting you give to NMCs versus volume or type traits. Don't abandon the index, but adjust your filters. Identify 2 alternative sire families that move away from your historical choices.
Long-term positioning, 1 to 2 years. Ensure all your genetic decisions are anticipating tomorrow's contract. If your processor is clearly heading toward a strict 3.2% plus protein requirement, your replacement targets and genetic filters need to reflect that now.
Second takeaway, manage genetic concentration. Inbreeding costs real dollars and lost fertility and health.
Immediate action this week. Call your AI representative and request the genomic kinship data on your top 5 prospective sires. Flag any sire that shows an elevated relationship over 8% to your core ancestors like Mogul or Oman.
Medium-term strategy, 3 to 6 months. Genomic test your top-tier heifers. That $40 to $50 cost per head is instantly recovered if it stops you from breeding an inbred animal or steers you away from keeping a lower-merit heifer.
Long-term positioning, 1 to 2 years. Actively select and utilize one genuine outcross sire from an underrepresented maternal line for 5 to 10% of your matings. This is not an academic exercise. It's maintaining genetic options and health for your entire herd structure.
And the third takeaway, account for trade-offs. Specialization costs money if it doesn't solve your specific high-cost problem.
Immediate action this week. Review the 5 red flags in your current involuntary culling rate. If culling is high, you must prioritize health and longevity traits over small production gains. If calving is fine, don't overinvest in calving ease.
Medium-term strategy, 3 to 6 months. Run the full 5-year economic math on a few TEF matings. Account for production, components, replacement costs, and feed costs. Make sure the specialized trait you're buying actually pencils out in your system.
Long-term positioning, 1 to 2 years. Integrate feed saved. Specifically RFI, traits heavily. Why? Because feed costs are 58% of your income. That is the single largest leverage point for sustained profitability, regardless of market price fluctuations. Efficiency is always a guaranteed premium.
This has been another Bullvine podcast from the Bullvine Podcast. For more Street Talking industry analysis, head to www.thebullvine.com.
Subscribe wherever you get podcasts. We're out with new episodes every day, and upcoming topics will be exploring the new USDA data on forage quality trends and the economic impact of labor availability on parlor efficiency. You don't miss it.